Good morning. This is Tim Harris and Julie Harris, and our author expert today is Diane Kennedy, and this is the Harris Real Estate University Friday Superstar interview. Now, for those of you who are attending a Harris Real Estate University Friday Superstar interview for the first time, let me let you know what you're in for. Every Friday at 9 a.m. Pacific, 12 noon East Coast time, Julie and I select somebody from the real estate community, or not necessarily from the real estate community, but it's somebody that has something to offer to the real estate community that will, frankly, educate you and motivate you. Sometimes we interview top-producing realtors, as a lot of you guys know. Sometimes we'll interview somebody who is, again, not necessarily in the community but has something to offer. We've interviewed famous economists. We've got a great interview coming up with some executives from the National Association of Realtors, things of that nature. Well, today's superstar interview expert is probably, I was just reading your notes on your bio, Diane. I don't even know where to start on this. It's really quite amazing. She's written numerous books. I mean, how many books total? I'm trying to read off how many here.
Yeah, there's actually 8 total.
8 total. Okay, great. And probably, I think a lot of you will know Diane because she's written a lot of books with a lot of other famous folks like Robert Kiyosaki. Now, you wrote books part of the series. You wrote part of the books of the series of the educational books that they put out. I'm not saying it right, but that's what it was, right?
They called it in the beginning the Rich Dad Advisors, and I was one of the first Rich Dad Advisors. And then I was on a program called Choose to Be Rich. It is a program that was done through Time Life. That's been a 3 years ago that we did that one. So it was both written and audio, and a big chunk of that is real estate, as I'm sure you know, because that's where he made his money, was real estate.
That's right. And so you have your newest book, which is a fantastic title. We're just talking about this. It's called Smart Business and Stupid Business. So let's just jump back in, and we'll kind of backfill with more of your information as our attendees get to know you better. What do you consider smart business?
Well, I think the main difference between smart business and stupid business is the average in the U.S. is that a business is going to be out of business in 5 years or less. And that's what I consider stupid business. A smart business is one that's able to move with whatever happens with the economy, with the times. It's one that's built solidly so that there's a business value that you're growing as you go. It's also that you know how to read the stats of your business. You know how to read a financial statement, but even more importantly, be able to pull out the key leading indicators so you know where your business is going and you can then prepare for that. And you're also protected. If you get an IRS audit, it's not the end of the world. You've got controls in place to make sure everything's working the way you want it to.
So you obviously worked with a lot of real estate people and a lot of very famous and wealthy real estate folks. You mentioned the word key indicator. So on a micro level, understanding that most of the folks on this call are real estate practitioners, what would be a key indicator in their business? And I'm sure this is relevant to any small business. What are the things that they should be watching?
Well, as a CPA, I've got a lot of clients that are involved as real estate investors. And so I'm kind of coming at it from the investor side. And one of the things that they're watching is what are the markets where they're at. Not only the geographic markets, because some of them didn't really go through this boom and bust cycle. There's some that are just doing great. And the other part of it is at a very micro level, how is commercial doing in your area? How's residential? I think the media has got this broad brush they paint for everything that's going on in real estate. Oh, it's the end of the world. And yet I'm talking to guys that are making tons of money in real estate right now. One of my clients sold his house in 2 days in Southern California just a couple of weeks ago. I mean, real estate in certain markets is doing hot at residential. In other areas, it's commercial that's doing really well.
Well, let's just talk. This is kind of totally off the wall, but it's kind of an interesting point that you made to me yesterday during our pre-interview. We were talking about investing outside the United States, and you were talking about Rosarito, Mexico.
Yes.
And the question I asked you, and you must have kind of chuckled because you must have been assuming, well, Tim just must only watch CNN about Mexico.
Yeah.
The question I asked you was about safety. And
right.
you made the point to me, well, yeah, there's crime in Mexico, but, as far as most dangerous cities to be in, that was kind of an interesting point that
right.
like Rosarito as a particular area wasn't even on the list of the top worrisome cities.
Yeah, and the reason Tim's bringing that up is because right now I'm talking to you from my beach house in Rosarito, and I'm sitting in my home office looking out the window at the Pacific Ocean. We're 15 steps to a 6-mile sandy beach. And he said, aren't you afraid somebody's going to murder you or something? And Rosarito, by the way, is about 30 miles south of the border on Baja. It's down from San Diego. And the interesting stats worldwide on the most dangerous cities is the most dangerous city is Ciudad Juarez, which was the Mexican city we usually hear about. It's over down south of El Paso, most dangerous city in the world. Second is Caracas, Venezuela, and the third is New Orleans, which it's interesting that it's more dangerous to be in a U.S. city than where I happen to live. So, but again, sometimes we have to be really careful when we see media paint anything with a broad brush. So international investing, I have clients doing that now as well, too. It's a very interesting time to be an investor.
Well, that was the point you just made. Basically, was the point of it is that we all have to be experts and get to know our specific little markets on a micro level when it comes to actually investing. So guys, at the end or towards the middle of this call, Diane and I are going to get into a lot of the details about the real estate professional status with the IRS. Now, I'm going to guess that probably half of you on this call have no clue what that is. And the other half of you are probably actively using that tax deduction, or what some people would consider a loophole. But we're going to be going over the specific ways that you can use that to your advantage and some of the mistakes that people make. But for the sake of the thousands of agents that are listening to this call now and will in a replay, let's talk about some of the more basic business structures, and then we can get to investing. Does that sound good?
Absolutely. So there's two kind of areas I want to talk about for everyone on this call. One is that you have a business. You're a real estate agent. So you're receiving, chances are, most of the time you're receiving a 1099. That's what reports your independent contractor income. In other words, you're not an employee. You're not getting a W-2. Now, the thing I see that a lot of realtors make a mistake on is that they think that they're not really a business. Hey, I'm just a salesperson. But the fact is, with that 1099, you have a business, you're not an employee, and that gives you a huge benefit if you do it right. Now, what that means is that you want to set up a business structure. So if you don't, you're going to be what's called a sole proprietorship, Schedule C. Now, as a Schedule C, there's 4 major problems with that. Number one, you've got everything you own at risk. There's no asset protection without a business structure. Number two, if you're making income, then you've got to pay an extra self-employment tax, which is 15.3% and is going up under the health care bill if your income's higher. That number is going to be increasing, actually a few percent. It's going to be significant. Number three, you're not building business credit. It's a very interesting point that if you are operating through an S corporation or an LLC, which is a limited liability company, you can build credit separately from your personal credit. So for anyone who's had maybe some personal credit hits in the last few years, this could be a powerful thing. You could build this credit separately. And then number four, the one that's in my world as a CPA, you have a 1 in 3 chance of being audited as a sole proprietorship. If you become an S corporation, it's going to be about somewhere between 1 in 50 and 1 in 100 chance of being audited. So you go from 33% to 1%.
That's a very interesting statistic. I hadn't heard that one before. Why would that be true? Why would there be such a difference when it comes to audits and about what kind of structure you have?
Well, it's interesting. The IRS has doubled their audit force since last year. They've doubled the number of auditors. That's just incredible. And President Obama has called for a quadrupling, 4 times as many as we have now within the next 4 years. Now, a couple things have happened with that. One is that the auditors that they're hiring are not necessarily accounting degree. They don't have accounting degrees. They're not trained in bookkeeping or accounting or any of the little more sophisticated techniques that you need to know in order to audit an S corporation. So they've got guys that are going to come in at a more basic level. Well, that makes the Schedule C sole proprietorship is a much easier audit for them because you don't need to do a financial statement, et cetera. The other thing is that typically a person who has a sole proprietorship, because they're not required as part of the return to have a financial statement, that generally the records aren't so good. And the IRS knows that. They've got a much better ratio of wins when they go after a sole proprietorship. And that's why they focus there.
When somebody, you mentioned, keep on mentioning audits, and I know that's going to put a fear of God in a lot of people on this call, and maybe in a lot of ways it should. But when somebody goes through an audit, what exactly is the process? Is it something that you can appeal? How long does it take? Is it oftentimes for a small business owner over a specific item, or do they audit your entire return?
What a great question. Because we've got this is going to be increasing. It's something we're going to all have to deal with a little bit more. There's 3 types of audits that they do: a correspondence, a field, and an office audit. The correspondence audit is the easiest one. They basically send out a letter and say, hey, send me proof that your travel expenses were really that. And you can mail it to me or fax it to me. That's great because your interaction is lower. An office audit means you and or your representative go to their office. And then a field audit is when they come to you, and that's the hardest audit. It's also the least likely audit that's going to occur. In most cases, the audit, in fact, I just was talking to a friend of mine who just got the IRS audit letter, and it really wasn't much they were looking for. They wanted proof of, I think, his auto expenses, so they wanted to see some kind of log, and they wanted to see travel, and I think the other might have been meals. But the thing that was happening to him is he called, because they always say, call us when you get this letter, and it became a fishing expedition on the phone. Now, he was smart enough that once he realized that was going on, he just stopped answering the questions and said, I'm going to have my representative talk to you. And that's the best thing you can do, because a lot of these letters you get, they're just trying to get you to say something that might open up the door for additional audit. But if you give them the right answers and you keep it very clean and don't volunteer anything, then you've got a really easy audit in front of you. And generally, if they realize there's no problem, they're not going to pursue.
Well, a lot of people think that auditors are actually on some sort of commission or incentive to go about seeking and destroying people's tax returns. Is there any truth to that?
They have certain quotas that they're supposed to meet. And these are government employees. They're paid by the month or whatever. But they do have quotas that they need to meet. And so there is a certain amount of, if I can find a big fish to bring down, then it looks good on their resume.
Sure, that makes sense.
Yeah.
So getting back to specific write-offs and ways that small business owners, now obviously we're focusing on agents and brokers, can go about saving money, maybe doing some tax planning. Well, first of all, tax planning, what does that term mean?
Basically, planning has to be done in advance. And it's interesting because right now we're thinking about 2009, and we want to get the returns done. Now, obviously, there's some things you can do that can get you some better tax breaks and reduce your chance of audit now as you're filing your return. But for the most part, there's not planning that you can do for 2009. It's done. What we need to be talking about and thinking about now is what's our 2010 planning going to look like? You do that ahead. I have some clients now that we're working on plans 5 years out, because if you have enough time, there's a lot of times you can reduce your taxes to hardly anything with good planning ahead of time.
Well, so let's specifically talk about what are the most commonly overlooked write-offs for a small business owner. Where do they typically screw up?
Okay, number one has got to be the home office. People, for whatever reason, are afraid of taking the home office deduction. And actually, I shouldn't say for whatever reason. This all dates back to a 1994 U.S. Supreme Court case. Now, that tells you how old I am, that I can remember this, 1994, because I was in business then. In 1997, the laws changed, and the interesting thing is a lot of people kind of overlook the fact how easy it is now, since 1997, to take the home office deduction. All you need to do is have a space in your home that is exclusively used for business and that you regularly do some kind of business there. Now, you can have another office somewhere else. You don't have to see clients there. It just basically do some regular business there. So it could be going on checking listings. It could be checking your email account. It could be working on your website. Those are all things you could do at home. Now, a couple of benefits that come from that. One is that the portion of your home that's used for that home office, that's considered the business percentage of your home. So if it ends up being 10% of your house, now suddenly 10% of your mortgage interest, your property taxes, your homeowner association dues, your insurance, your utilities, repairs, landscaping, janitorial, you get the picture there. All of that becomes a deduction against your business income. It's just free. And when you sell the house, you don't have to recapture it. It's just a free little gift if you want it from the IRS.
What are other commonly overlooked write-offs? Definitely home office deduction.
Right.
Everyone on this call, I can't imagine there's anyone on this call that's not going to be able to use at least partially the home office deduction. What are the other things that you see that small business owners?
Yeah, the next one I'm going to say is their car. And I want to kind of segue this into the home office that we were just talking about. Mm-hmm. The deal with your car, in order to get a deduction, it has to be business miles. The definition being that from your home to your first business of the day, that's a commute. It's not deductible. But from there on, if you go, you're driving around looking at property, you're meeting with a client, you're meeting with the mortgage lender, whatever you're doing, those are all business-related travel. Now, one of the secrets is if you have an office somewhere else and you don't have a home office, from your home to wherever you go, that first part of the day is considered a commute. And it's not deductible. But as soon as you have that home office, you now have a commute that's like walking down that hall in your bunny slippers. Because once you're there, everywhere you go from there on is a business write-off. Now,
so do you have your home office out on the beach?
It is right there, and from here on, everywhere I go that's business-related is a write-off. Now, realtors tend to use their car a lot. So don't be afraid of taking that mileage, and the home office is going to help substantiate a larger number of business miles simply because you don't have that commute anymore. So just a little tip there. This is a good one. Now, the one thing that most people hate to do about the auto is keep track of the log. Usually, though, what we tell our clients, try to get at least 3 months of a travel log where you have your business miles and your personal miles. Based on that, we can extrapolate out what the percentage is then for the year. Ideal is every single month, but the reality is not a lot of people do it. So if we can get 3 months, we can extrapolate it out, and that tells us a business percentage. And then that percentage can be taken against the lease payment, or we can take the number of miles times the cents per mile that you get on your mileage rate. And as far as which is best, usually keep track of everything and then figure it out at the end of the year which got you the better percentage, which got you the most money.
That's right. So what about business structure? Here's an interesting question from Kathy from Grass Valley. I'm just going to read this just as she wrote it. I was told by an accountant that it is not cost effective for me to incorporate as an S-Corp until I earned over $800,000 gross. Also, it is my understanding that you need more than one person to be an LLC. That was a question.
Okay. Interesting questions. I love Grass Valley, by the way. I love the Sierra Nevadas. But it's interesting about the $800,000. That seems really, really high. Now, California is going to charge you $800 a year. For the Franchise Tax Board charges that for any kind of S corporation. So you do have this extra fee in there. But it's not really the gross, it's the net that we need to look at when it comes to whether it makes sense or not. So what is your taxable income going to be? The sole proprietorship is going to be an extra 15.3%. But other than that, the other pieces of that, for example, is it worth it to go from a 1 in 3 audit to a 1 in 100 chance of audit? Whether it's that $800 you spend per year might be the cheapest money you ever spent if it's avoiding an audit for you. The other part of that, the question as far as an LLC, a limited liability company, you can have a single member LLC. Now, if you, then one of the things we would do is a single member LLC, we would then elect how we want to be taxed. An LLC is just this cool little chameleon. It gets to decide whether it wants to be an S-Corp or a C-Corp or a partnership or whatever. So probably for a realtor as a single member, we'd be looking at an LLC that then elects to be taxed as an S-Corporation.
All right, perfect. So here's an interesting question. Someone asked, actually 2 people asked this question, which frankly really surprises me. A lot of them are educated, they're California residents. Actually, one was on this call that asked this question was California, the other one looks like Idaho. And they want to know if they can start their real estate corporations in Nevada, being that it's a no state tax state.
Right. It's interesting that somebody from Idaho would ask that. I definitely know why you would ask that in California, because the state tax rates are so high. The thing we have to look at is something called nexus, and it rhymes with Lexus, but what nexus in this case means is connection. You have to have a connection to the state where you're earning income. So even if you set up a corporation in Nevada, if all of your work is being done in California, you've got a California license, you're making sales and commission in California, you've got California income. So even if you set it up in Nevada, you're going to have to suck it all back into California. And in that case, actually, it ends up being more costly because you're having to pay Nevada for setting up the corporation and running it, and then you're ending up having to pay California on top of it. So I would just go with the state you're in. Now, that said, let's say our Idaho resident decided to set up a website and has created an e-book about something that they're selling. Now, if that's being delivered all digitally, there's no reason that you couldn't have a Nevada corporation doing that because we don't have the nexus back into the home state of Idaho.
So some interesting questions coming in about asset protection. We're going to guys, we're kind of dancing around a little bit here, but I'm just trying to keep it on focus based on your questions. Asset protection as pertains to small business owners. What does that mean?
Asset protection is, in general, there's two things we want to do. One is that we want to protect the business from something that might happen personally. For example, and I love this example because I have a teenage son. So let's say you have a teenage son who's just gotten his driver's license and he's out driving somewhere and gets in an accident and there's a judgment now against you personally. Now, the judgment and the lawsuit and the judgment could then go against any assets that you own. So we want to be able to protect the business from something that happens personally. Now, additionally, let's say your assistant is driving to Kinko's and hits somebody. I don't know why I keep thinking car wrecks, but something that tells you I have a teenage son. So driving to Kinko's, something happens, and now we have a judgment against you personally. So we want to protect you personally against something that happens inside the business. Now, an S corporation provides what's called a corporate veil. As long as it's been set up and run properly, there's certain corporate formalities. You don't commingle funds. You have to give notice as a corporation, et cetera. As long as you're following those things, then your personal assets are going to be protected. So if something happens in the business, they can't come take your college fund for your kid or your savings account. Now, the challenge with the S Corp, though, is that the straight S corporation, if something happens personally, that stock can be attached. And that's why I'm glad we got this question because, to be honest, today's world, I prefer seeing an LLC set up first because an LLC protects both ways, protects you from the business and protects the business from you, and then have the LLC elect the S Corp tax treatment. It seems like an extra step, but that election doesn't cost you anything. And by doing that, you've just added another layer of protection.
Nobody asked this question, but I'm going to ask it too because I think it actually might kind of put a period at the end of this whole idea. But trust, specifically like a Spendthrift Trust.
Right.
And so guys, I'm specifically going into some of these questions at a level that I know some of you probably are a little bit unfamiliar with. It's okay if you don't understand all of this. Diane obviously does an excellent job of explaining it, but at least open your mind to what we're talking about. So, Diana, here's just, I'll kind of put this in a different conditioning, if you will. So we have a lot of agents that are students at the university that are frankly making more money than they've ever made before. You know, they're some cases they're making millions of dollars now, whereas 2-3 years ago they weren't. And so they're accumulating assets. They don't really know how to protect them. They don't really know essentially, well, what am I opening myself up to in terms of litigation issues potentially.
Yeah.
And one of the things that we advise them to do, obviously, is seek the advice of somebody like you and consider putting all of their assets behind a trust. And I think it's Nevada and Alaska, and I think there's maybe Florida, has a really nice little widget called a Spendthrift Trust. What's your view on that?
I think, first of all, this is not a do-it-yourself project.
No.
Trust, the challenge and benefit of this kind of a trust is it's what's called irrevocable. In other words, you can't change your mind. Now, that's what makes it work. If it was revocable, then a court can come in and break it apart. But the irrevocable part of it also has a gotcha in there, is if you set this thing up wrong, you could end up in a really big problem without having thought through it all. Let me add in a couple of other asset protection devices that I really like as well. One is a pension plan, especially if you can set up a self-directed pension plan. And in the right circumstances, your pension plan then becomes the one that buys your real estate and can even own passive businesses. The pension plan isn't touched even in case of bankruptcy. So as long as, again, it's been done correctly. The other one is, in the right circumstances, cash value of life insurance. That's another one that's absolutely protected and stands the test of courts and time that you can't get to. So those are great devices. I like the trust. I like the pension. I probably would go with pension first simply because you can administrate it yourself and there's a lot more flexibility. It's easier to work. And then probably the trust after that.
Okay, great. So guys, enter your questions into the webinar, and those will be the questions that I use, obviously, when interviewing Diana. Hopefully you guys are getting a lot out of this. This obviously isn't a lightweight call. And as some of you build your businesses and start building some assets, you're going to want to definitely go back and re-listen to this, or you can just go straight to Amazon and buy some of Diane's great books. Julie and I think, own all of those and have given some of those out as gifts over the years. I put a little link on the webinar there that you guys can click to her Smart Business, Stupid Business Amazon page, and you can just pick the book up. You can actually buy that during this call or after the call as well. So here's kind of a strange question that we just got in. I'm going to ask you this, and then let you and I just jump right into what I think is probably our favorite topic, real estate professional status.
Perfect.
Is it immoral to want to save taxes? And that was an actual question.
Wow.
I got smart people.
Yeah, I love the fact that it's come down to kind of an ethical question as well. We have Justice Learned Hand made the comment that said, I'm going to paraphrase it and kind of butcher his quote, but basically we have the right to set up our circumstances so that we can pay the least amount of taxes possible. And that came from a justice of the U.S.
Yes, Supreme Court. Yep.
So the fact that we have that, clearly, I'd like to say that the IRS has put loopholes in there, and a tax loophole is nothing more than a government incentive to promote public policy. Especially maybe a couple of years, the last couple of years have been a little different in some of our tax law changes, but prior to that, there were a lot of tax incentives to have a business and real estate, and that's public policy. If people have businesses, they're employing people. They're making capital investments.
Right.
They're not relying on an employer or the government for a living. They're instead becoming the person who provides that.
Well,
real estate.
Let me interject that because I just to make this point, because obviously during these times there's a lot of people that have conflicts when it comes to, because there's so much unemployment and all the other things that are happening in our economy. But Diane just made a really, really valid point, and I think that you guys can share this point with your potential investor buyers in addition to yourself. So a loophole is nothing more than, as she just said, the government incentivizing you to partake in a certain activity. And as an investor, as a property investor, or even maybe in some cases as a flipper, they want you to be a long-term landlord. They want you to own rental property because you essentially are providing housing stock for people to live in. And that makes it so that the government doesn't necessarily have to get into the housing business. So they want to incentivize people to do certain behaviors. So a loophole is not. It's not like all of a sudden you found like a diamond on the beach. A loophole is put there intentionally. Of course, the name is what I think probably gets people confused. But it's put there intentionally to motivate people to partake in a certain behavior that the powers that be have determined to be beneficial to the population, to the community, to our country as a whole. So just keep that in mind. And when you're choosing your tax planning professional or your business wealth building advocate, somebody like Diane, look for somebody that's very well educated in all these things, so that, frankly, Diane's already sorted out where all the best quote unquote loopholes are, and all you got to do is read her books or ask her for advice. It saves you a lot of time and ultimately will save you a ton of cash. So let's talk about the specific tax real estate professional status. Let's talk about what that is and break this down to the very basics, because like I said, Diane, I suspect that half of them won't even know what this is.
Right. Often when I talk to groups, especially if I'm talking to realtors, I'll make the statement that if you qualify as a real estate professional, and I'll tell you in a second what the IRS means by that, but if you qualify as a real estate professional and you're paying taxes that you don't want to pay, either one, you don't own enough real estate, or number two, your tax advisor doesn't understand how the real estate professional status helps you. So that said, the real estate professional status under the IRS definition means that you are involved in real estate activities more than you are any other trade or business. So if you're working part-time as a realtor and part-time as a nurse, as long as you're spending more hours in your real estate activities than in your nursing activities, you're going to meet phase A of this test. And phase B is that you have to spend at least 750 hours a year doing that. So as an active realtor, I'm certain you're qualifying, unless you're also working a million hours doing something else.
Well, Diane, that's a really important point, what you just said, though. Let's make sure that they're really clear on that. That 750 hours is pretty much the part that people screw up. So it's 750 hours per year individually, but also as a couple. So if you're married or, filing, you have to be filing jointly to be able to claim this, I assume, if you're going to say basically it's an accumulation of the hours, correct?
Well, no, actually it can't be between the two of them. It has to be just one person as the real estate professional.
Oh, gotcha. I didn't know that. Okay, got it. All right, good. All right, sorry about that. Sorry for the confusion.
Yeah, well, and just as an example, I had a client who was a doctor and spouse became a real estate professional. Now, in this case, she had actually been working part-time doing something, and the best thing she could do for their tax planning was to quit her part-time job so that it was no problem proving the real estate activities. And then they bought a lot of real estate properties, which the paper losses, we're talking tax losses, not in your pocket losses, but the paper losses from real estate could offset his other income. And that's primarily from depreciation.
Okay, so let's tell them what the benefits are of a real estate professional status versus somebody who doesn't qualify for a real estate professional but does have rental properties.
Okay, now we need to look at when I talk about the paper losses, and that's one of the biggest things that we've got with real estate investments is we get to take this phantom expense called depreciation. So, and with a couple of other techniques, you can actually create a lot of depreciation in years that you want to have it, and that makes a paper loss. Now, if your income is under $100,000, you can take that real estate loss against your other income only up to $25,000. So if you have $30,000 of paper losses, then you only get to take $25,000. If you make over $150,000, you can't take any of that loss. Between $100,000 and $150,000, it phases out. Now, there's an exception. If you're a real estate professional, under those guidelines that I talked about just a little bit ago, if you're a real estate professional, you can take 100% of that loss against your other income, no matter how much the loss is, no matter how much your income is. And that's where the secret is here for real estate agents. Buy property, hold it, and then you can create that depreciation that offsets your other income.
Well, so that's I remember the first time Julie, are you still on the call?
Yes.
Okay, I remember the first time that you and I learned about this. I remember we were in the audience listening to somebody speak, and they talked about this topic. I remember you and I looked at each other, and I could see the light bulb in your eye as I was seeing it my own. Because the fact is, Diane, in business, especially in real estate business, there really isn't a better write-off, I'm going to throw it out there, than this. This is if you qualify, this is potentially the greatest gift that a small business, real estate professional qualifying person can have. As far as deductions go, is there anything better than this?
I mean, the thing is, you're building wealth, and what a great time right now in our economy to be looking at it. The other thing is, you guys are all insiders. People on Wall Street go to jail for being insiders. You guys get benefit. I mean, you get less tax if you become an insider. It's a great deal.
So as far as I want to make this really clear to folks. So in a normal write-off situation, let's say, for example, you're writing off an automobile lease, right? And then, you don't write off necessarily 100% of the lease payment. You write off the lease payment, the insurance, and then you figure out basically what percent was business use, and you get to write that percent off in your taxes. I mean, that's oversimplification. That's basically it, correct?
Yes.
Okay. Now, the difference is what you're describing. So let's say, for example, you earned $250,000 and you live in California. So let's say you have a federal tax bill of, $30,000, $35,000, and you have a state tax bill of $10,000. But let's say that you have a rental property and you're a qualifying real estate professional. Approximately, this is kind of a crazy question and no one's going to hold you to it, but how much in real estate investments would they have to almost zero out their tax obligations?
What were those numbers again? I'm going to have to quickly do some math here.
Sure. Well, I'll just pick something random, like I said.
Okay.
So someone earning $250,000, okay, and they're in, let's say they're in California, so they also have a federal tax. A state tax of, 8% or something.
Yeah. So if they wanted to completely zero out their taxes, they're going to have to come up with enough real estate that it would create $250,000 worth of loss. Now, by loss, in this case, I don't want you to actually go out and lose money, because if you lose money, that doesn't make any sense. So we're talking about
let's make it really clear so they understand.
Yeah.
She's not talking about basically negative cash flow in terms of loss. She's talking about basically, let's say you go out and buy rental properties and you have mortgages on them, and other people are paying for the mortgage payment and you're not going out of pocket every month. Let's just say you're breaking even. She's talking about being able to you literally can take all the interest, the principal interest payments, the total payments, all the maintenance and the upkeep. Finish this, Diana. What am I forgetting? And basically, go ahead.
All of that. And now, hopefully you're writing off all your other expenses against your business. But if you had some other things like travel to go visit this property and those type of things, those could be expenses in there as well. But I think the biggest one is going to be that depreciation.
That's right.
So you're able to take that depreciation, depending on the type, somewhere between over a period of time of 5 to 27.5 or 39 years if it's commercial. Now, just a really rough rule of thumb is you can figure maybe about, if I'm looking at this $250,000 worth of income, let's say about $3 million worth of property would then completely zero out that.
I remember one time I was talking to a fellow, Julie, you'll probably remember this too, it's Jim in Florida, and Jim and his wife were earning like $850,000 a year in income from the real estate business, and we were having lunch with him, and I remember him telling us, well, he doesn't really pay any federal taxes because of this tax status, and he had something like, Diane, he had something like 125 rental properties, and but that's the way you go about doing it. And again, the government is incentivizing you to go out and provide housing stock for people that want or have to rent. So that's the reason that this works.
Right.
So how do people screw this up? I mean, obviously, I would think that this is audit bait if you do this incorrectly. Where do people make mistakes?
Well, the first one is I think people hear this and maybe get too excited and don't get the right professionals on their team who understand it. Just one of these, I use that example of a person who was a part-time nurse and a realtor as well. And let's say this person absolutely qualifies as a real estate professional. Now, then when it comes time to preparing the tax return, that spot where you put down what your occupation is,
you told
put down nurse. I guarantee that's going to get flagged for audit because you've just taken real estate professional status and then at the same time said, oh, by the way, I really don't do that. I work full-time as a nurse. That's what it's going to look like on your tax return. So just a silly little thing like that can mess you up if you've got somebody preparing your taxes who doesn't really understand how this works. The other part of it is that there is a part on your tax return that needs to be completed. It's for anybody who's interested, it's in Schedule E, which is where you report your rentals or your flow-through from LLCs and limited partnerships, that type of thing. And there's a part that has to be filled in there. People sometimes, when they're trying to do their own tax return and they use something off the shelf, don't do that because it doesn't prompt them to do it. Like TurboTax doesn't ask them. And if it doesn't get filled out, then you've lost that.
So it's just kind of funny. I want to read some of these questions. Sorry for interrupting. Jim from Southern California, he just put in this question. You can tell he just had his light bulb moment, Diane.
Oh, good.
Did you say the principal as well as the interest can be deducted? Yes.
Well, the principal gets deducted because
depreciation.
Because of depreciation. Yeah.
Right. Exactly.
Yeah.
So Jim, that's right. And you basically the 750 hours per year. You can't have any other, to use her example, you got to, obviously be smart with this. Are there any other areas that people will typically screw this up? People that try to make the claim, but then when they get audited, the IRS says, well, you actually didn't qualify as a real estate professional. How can somebody, remember on this call it's mostly real estate practitioners, how can we make sure that they qualify for the deduction? What else?
Well, I think the biggest thing is keeping track of your hours. I love talking to this group because you guys are clearly in the business of real estate. I mean, the fact that you're a real estate agent gets you that. Now, just to throw this out, because some people might have heard that there was a problem with taking a real estate professional status and getting more audits. About 2 years ago, the IRS started these audit teams going after the real estate professional status, and they started in California, probably because there were more people taking it there because they were trying to get all the losses. Well, in the beginning, they were a little crazy in these audits. Luckily, the IRS has lost every single one of the tax court cases where they were a little crazy in what they were saying. So we've got much clearer rules today. 2 years ago, you might be a little nervous taking it. Today, no. Because
they went after brokers, didn't they?
Yeah, well, they actually went after agents. It was a crazy thing they did. When they define what a real estate activity is, one of them is brokering a real estate deal. In other words, doing what you guys do. But the IRS came up with this crazy idea that you had to be a licensed broker in order to broker a deal. So they were denying agents who weren't brokers, and they lost. Every single case that came up, they lost. So that's been cleared up. And I'm just throwing that out in case somebody hears this. It has been fixed, thank goodness, and the IRS got their hands slapped over that one. But what they do want to see is that you're active in the real estate. It's not just getting a license and hanging it. You know, there were some people that maybe just took the test and said, okay, now I'm a real estate professional, but they never sold anything. They never showed a property. They never got a listing. They never did anything. You need to show you're active.
That's right. Okay, excellent. So changing gears, is there any other specific topics that popped into your mind as we were talking about this so that in case we're not asking all the right questions, things
well,
that you
I'm
want to make sure people know?
One more thing just to show, and I'm going to just talk through it quickly. Don't worry about knowing what this means. Just make sure your tax preparer does. There's actually a two-pronged test. You have to be a real estate professional, and then you have to do something called material participation with your property. And what that means is that you need to spend 500 hours a year or more. Now, since you're already passing the real estate professional test, it's like, okay, this is a no-brainer. But there's a little gotcha in this, is it's 500 hours per property unless you make an election on your tax return that aggregates the property. And I know some people just fogged over on that one. Don't worry about doing that. Just ask your tax preparer to make sure they understand the 500-hour rule. And if they don't make the election, you might want to think about talking to somebody who knows how to do that right. It's a simple thing to do, and if you do it right, there's no problem. If you miss this one, it could come back and bite you.
Why would there be an election to aggregate your hours if they're trying to look to see that you're spending 500 hours? Why would there be?
The way it is in the code, it says 500 hours per property. And like I'm thinking of your friend down in Florida who's got 125 properties.
Yeah,
that would be ridiculous.
Yeah,
so
I see.
I'm certain that he has aggregated, he's put them all together and said, hey, I only have to meet one 500-hour rule. I don't have to do 500 times 125.
So in other words, he would aggregate all the property hours and say, basically, I'm spending 500 hours total on all of them. Is that what you're saying?
Yep, that's it. And it's just this thing you have to attach to your tax return that says that. And it's another one of those, you just got to know the inside scoop on how you do it.
Well, this material participation thing, this is relatively new, isn't it? It's
been around, but I think what's happened is the IRS is getting a lot more sensitive to every little piece they can come after somebody on if they miss it. We've been doing it for years because for years I've been in that specialty of working with real estate investors. I've had lots and lots of clients as real estate investors.
So we've had a couple interesting questions here. I'm kind of hesitant to ask these, but I'll just throw them out there anyway. So a lot of people are asking about the idea of forming offshore corporations and things of that nature. And do you have an opinion on that, or do you just want to take a pass?
Well, the reality, can you set up an offshore corporation? Absolutely. Can you do it legally? Certainly. However, you better disclose it all because right now it's all falling under the Patriot Act. And
right.
So, we're not talking that, you're going to get a penalty. We're talking you could be considered a terrorist. So, just really be careful on this one. That all said, I have clients who have properties, maybe they bought in Costa Rica. So they have a limitada, which is like a corporation, in Costa Rica to hold it. And it's absolutely legitimate. They got bank accounts there so they can pay the rental expenses, take the rental income. Got a lot of clients in Belize that are American. So they're still filing U.S. tax returns and disclosing. And can you do it legally? Of course.
Right. So, but there's a little kind of law that's special for Americans that no matter where you are in the world, no matter even if you're earning all of your income and you're over in Italy or whatever, as a U.S. citizen, no matter where you are in the world, you still have to file a federal income tax return and still pay taxes on that income.
Yes, you have to file a tax return. There is a little bit of a way around some of the taxes, but you have to disclose how you do it.
I think Tim Geithner actually was a little confused about that one, I think, if I remember correctly. That was where,
yeah, and he's head of the Treasury now, but anyway.
Yeah, well, what are you going to do, right?
Yeah.
All right, good. So a lot of good questions. Sue Williams from Marietta, California wants to know that statistic on the ratio as far as audits being an S Corp versus an LLC. You said it was 100 times more, yeah.
Yeah, so it was a 1 in 3 chance of a sole proprietorship being audited, and the corporation, the S Corp, is either 1 in 50 or 1 in 100, and the reason I'm giving you two different is it depends on the gross income of the company. If you're over, I believe it's $1 million, then you've got a higher ratio, higher chance of being audited.
So here's an interesting question, and I like this one too. It's a lot of great people are really appreciating this interview, and I really appreciate the feedback that all of you are sending me through the webinar. I'm not going to take the time and read all your compliments and praise for Diane.
If
you'd like, go buy her book. I'm telling you guys, she can break this stuff down so that it's, as we call in the university, Tim Simple. If I can understand it, everyone else can understand it too. All right, so here's a great question. This is kind of a long paragraph, but I'm just going to summarize it. Why is it so hard for people to accumulate wealth?
Boy, that kind of gets into almost the psychological part of it.
It does.
And I guess I'm not sure quite how to interpret the question, but I'm going to take it that way. I think there's this question, there's this idea sometimes that people have a challenge with delaying gratification, and accumulating wealth really is all about that delaying gratification. It's way easier and cooler to go buy a red sports car than it is to buy a rental property, you know?
Yeah, that's definitely true. But the other thing is, and again, I think your recent book actually kind of touches on a lot of this too, that if you don't plan for it, it's not going to happen. A lot of folks in our industry, Diane, they have this, Julie's got actually a lot of great stories for this, but folks, agents, brokers that think you just become wealthy the more houses you sell, right? So if I don't have enough money, if I don't have enough retirement, if I don't have enough financial security, well, I'll just sell another 50 or 100 houses. What folks don't realize is that you don't become wealthy from the money you earn from basically selling houses. You become wealthy from what you do from the money you earn from selling houses.
Right. And, there's basically, when it comes to wealth building, there's two problems, money problems. One is not enough money, and the other is too much money. Because too much money brings its own set of problems. You've got more chance of lawsuits. You've got higher exposure. You've got maybe you get in this habit of throwing money at problems instead of looking at the problem. And I don't know, I've been guilty of that in the past myself too. The business is really going. I don't have time to deal with that. We'll try to fix this without really looking at the system issue on why this problem is occurring.
There's a lot of interesting questions about what's going to happen as far as tax rates and things of that nature going forward. Can
I get on a soapbox for a second? Just a second.
Please,
on that one.
soapbox away. I love your soapboxes.
Well, we hear about this. We've heard about bad science. There's lots of questions on things. I think that what we're having right now is a case of bad math. And what I mean by that is there's a lot of talk that I've heard from Congress and various political figures saying, hey, the tax rate's only going up 5%. And that's what's happening at the end of this year. So we've got some tax items that are expiring that were under Bush's law. So now we're going to have them going up, like the 10% bracket goes to 15%. Now, people hear that and they think, okay, my taxes are only going up 5%. But the reality is your taxes are going up by half. They're going up 50%. So, because if you go from 10% to 15%, that's a 50% increase. So for somebody who was, maybe only paying $2,000, and they're thinking, it's only going to go up 5%. You're going from $2,000 to $3,000. Now, that's at the low end. And that's the part of all of these tax changes that have got me concerned. I think there's going to be April 15th this year, you think is tough? Wait till next year when people think their taxes aren't going up that much. Now, at the high end, oh my goodness, look out. Your Medicare's going up. Your investment income is going to be subject to Social Security and Medicare tax. You're going to see the tax bracket increase. On average, you can expect your taxes to go up by 40%. That's the numbers we've been coming up with at the higher end of income.
What's that? So what would that be? Give us for example.
Like, for example, if you're currently paying $150,000 in taxes, you can expect to be paying over $200,000 in a year.
That's incredible.
Without making the same amount of money and without doing any of the tax planning. And that's the part that we like to do. We want to start talking now about how you're going to handle 2011.
Well, so that goes back to the previous question about why is it so hard to accumulate wealth?
Yeah.
Right? Why is it so hard to, for people truly to get ahead? Well, I think that would be a perfect answer right there.
Right.
I mean, going forward, you have the IRS, unless you're doing some real smart tax planning, is going to be taking a larger portion of your income.
And
go ahead. I'm sorry.
Forgetting about the IRS, I think we're going to see even more problems in the state. For example, the state of Washington is, I'm not sure if you've got anybody on the call right now from Washington. Yeah. They've got this crazy law they're talking about of starting to tax on realtors' commissions. Which is almost like, and as an accountant, I'm up in arms about it because it's a slippery slope. Once you start doing professional. Yeah.
Right. Well, different states have tried to pass that forever. When Julie and I were selling real estate in Ohio, that crept up.
Wow.
Where they're trying to tax services. So agents listening to this call now and in replay, wake up and find out what's going on in your state legislatures because they're all scrambling for bucks. The property taxes are being reassessed. People are obviously down at the courthouse demanding that their property tax basis be lowered, and the cities still have these massive amounts of people and fire hydrants and the rest of it that need to be paid for. So they're definitely getting more crafty. I know in California, Diane, they have really started cracking down on traffic violations. It's speeding and people rolling steins. They've doubled and tripled the fines. So there's lots of little overt taxes and lots of little hidden taxes that we're going to all have to deal with going forward. Is there anything that's going to stop that momentum of higher taxes? Do you think there's any way we're going to be able to slow this thing down given the debt crisis in the country?
It's not going to happen soon or easily. I'm not sure. I do want to say, though, that there, especially at the local level, there is something you can do about this. My partner, Megan Hughes, is active in a lot of my teleseminars that I do. Her husband is a senior tax analyst for the state of Nevada. Now, it's interesting is that because we always get this little inside tip on what might be happening in Nevada, and Megan has been able to stop 2 specific bills from going through simply by being able to rally the troops and getting a letter writing campaign going. I don't even think it was that many. Maybe 20 or 30 letters got written, and they killed a bill over that. So pay attention. If you don't like what's going on, there is something you can do about it.
Since you talk about Nevada, and I have a personal interest there, and since you brought that up, and I know we have a lot of Nevada residents, is there any truth to the rumor that Nevada's sort of secretly exploring a state income tax?
Well, by Constitution, they can't. So they'd have to go in and change the Constitution. So the answer, as far as any of my sources, no. I think
God bless Nevada.
Yeah. The most that we're seeing is the rate, the cost to have a corporation's gone up, transfer tax on real estate's gone up. We've seen some of those things.
Do you have about another 10 minutes, Diane?
I do. Yes.
Okay, perfect. Let's talk about, so we've covered a lot of subjects, and I think we're touching a lot of, based on the questions and comments I'm getting in the webinar, we're touching a lot of things that I think people really need to hear. Well, so the average agent, Diane, is I think a 54-year-old woman, and obviously this 54-year-old woman has gone through a lot of stress in the past 5 to 7 years from the real estate bubble now to the real estate bust, and now she's starting to probably think a lot about retirement planning. And now we're telling her about her taxes are going to go up, and it's going to be harder for her unless she does some real strategic planning now to really accumulate enough wealth. So if you were talking with that person right now and you were trying to kind of prepare her for her retirement, again, a big general question, and you can run with this any way you want to, what would you suggest that she does?
I think number one, we take a look at what kind of real estate she owns right now and probably be looking at that. There's, in certain markets, incredible opportunity. Just incredible opportunity where things cash flow immediately at nice numbers. And that cash flow is coming to you tax-free because as a real estate professional, we get to take advantage of all those tax breaks. So that would be number one. I'd look at how much real estate can you afford to get right now and be able to put that money to building wealth down the road. And the second is, although this is kind of a standard answer, I like pension plans, but only if they're the self-directed type. So I don't want you to go out and get just a regular 401k and then, put it in a stock that you may or may not have any influence or control in. Instead, I'd rather see you getting something like a solo 401k, which is a specific kind that you can put up to $49,000 a year in and completely self-directed. You can use it to buy real estate. You can do it to invest in passive. So that would be the next piece of this. But I think it's investing to the future, but with good control. Don't put your financial future right now in the hands of somebody else.
That's very interesting you said that, considering the fact that you get paid to help people and, obviously plan their financial future.
Well, I want smart clients. I want clients that know this stuff, so they challenge me.
That's true. So basically people that come to you having at least have some information ahead of time so that when they actually come to sit down with you, they're going to appreciate the fact that you're going to take their education and thinking to the next level. And I 100% concur with you. Actually, when we have new students join the university, we are finding that sometimes the best ones are the ones that have come with previous training and education, and now they're ready to take their experience to the next level. So I know where you're coming from with that. Yeah. So as far as retirement on a whole, obviously a lot of people are redefining what that means. Yes. Some people are saying I'll never retire. Some people are saying, well, with taxes going up and, who knows what. There's all kinds of crazy things that are going on right there where, as baby boomers are trying to think about what's the next phase of their life. What trends do you foresee as relates to real estate as we're going forward as far as opportunities go?
Oh, the one thing that's nice about real estate is oftentimes the older agent is going to bring a life experience that's going to really appeal to others. And so it's across the whole board. A 25-year-old real estate agent is going to attract a different crowd, and there's lots of opportunities. Same with a 60-year-old real estate agent. It's going to attract a different group for investments. I think there's huge benefit there. We're also seeing a real changing in how we define where we want to live and how we want to live. And that anytime there's change, there's a lot of opportunity. And right now, I'm just blown away with the values. There's some markets that are the prices are so low it's ridiculous.
Where are you buying, Diane? You mentioned that.
Yeah, I'm actually, right now I'm sitting in the Baja, and I have one more teleseminar today, and then we're going to Reno, and that's where we're going to go look right now.
Right. Nevada, I think in a lot of cases is definitely overcorrected. It really is nuts. In Vegas, there's places that were selling for $500,000 and $600,000 that now are selling for less than $200,000.
Right. But we were looking in Vegas, and a funny story is a brand new subdivision, and there was this old windblown sign, houses starting at $300,000, and next to it a brand new sign that said houses starting at $20,000.
Isn't that incredible?
Yeah. $20,000, put it on a credit card,
Well, and it only makes sense that places like Nevada that have, no state taxes and a business could relocate there as taxes across the board start to go up. Guys, it makes sense that there's going to be a lot of opportunity in maybe some of the most depressed markets right now, like, for example, Nevada. As more businesses look for states that are a little bit more business-friendly tax-wise, and more baby boomers are thinking about retiring to areas that are going to be warmer and they're going to have better, again, tax situations. Guys, use your brains, use your real estate minds. You can pretty much guess where the best markets are going to be for you to invest in, and then get to know those markets on a micro level and make some strategic moves. Diane, listen, I really appreciate your time today. It's difficult for me to do an interview like this because, frankly, there's so much I wanted to talk with you about when we have such a limited amount of time because you're such a huge asset. I told Julie after you and I spoke yesterday that I wish we would have met you 20 years ago.
Oh, thank you. Well, we do it now. And, I think that maybe is kind of a great way to kind of stop to end the interview. Sure. Is that no matter where people are, you've got the future ahead of you. And, I think about the economy and the changes we've had. When we had the boom going on, it was like a rising tide raises all boats. It was like you made money even if you're being stupid. It was just like there was money everywhere. And it went out, and people thought, well, it's gone. But it's just like the ocean when the tide goes out. There's tide pools, and there's life everywhere. And that's what I see in the real estate market now. There's life everywhere.
You just have to have the courage to look and not believe the Mickey Mouse that's happening in the news. And you just basically encapsulated with a lot of our best students have come to understand from doing short sales and listing bank-owned properties. They made the shift successfully from the bubble boom mindset, and now are working at the other end of the industry, and a lot of them are making more money now than they ever did back when, quote unquote, everything was great. So I 100% understand. I know a lot of them do as well. So Diane, your book, if someone wanted to get started tax planning and that sort of thing, would they want to start with your most current book, or would you suggest they buy a different one? Or, you obviously have a big library for them to select from.
Yeah. Maybe to visit ustaxaid.com. That's my tax, where we've got a forum and a blog. And then Smart Business, Stupid Business has got some tax in there. There's quite a bit in there about business structures as well, because I know that question was coming up.
Yep.
And just in general, what kind of systems can you set up so you're not having to work so hard and the money's still coming in?
Okay, great. So, again, if they want to purchase your book, they can do that right now by clicking the button that's on the webinar, and then you'll be taken right to the Amazon page. You can also see all of her other books because they're all listed there as well. And in the meantime, go to her website. I have gone to her website many times before and read her different articles. She's a prolific writer. You've written so many things on the Internet and it's not just fluff stuff where you're just trying to lead somebody to something else. You're actually giving the specific details. So, guys, if you have any more questions for Diane, go to ustaxaid.com. Did I say that right?
Yes.
Okay, ustaxaid.com, and certainly get started by picking up one of her books. And I know there's a lot of you on this call that are right now starting to make more money than you've ever made before. You're listing REOs, you're listing lots of short sales. You have got to listen to what Diane said and start doing your planning now. Start making it so that you can keep a lot of this money that you're earning so you can have maybe for the first time in your life some financial security. You have to be proactive about this because essentially the deck is stacked against you when it comes to basically you keeping your money. So if you're going to keep it, you're going to have to make the decision to be proactive about your planning. And that's hopefully what you've gathered from this call. So Diane, thank you very, very much for your time today. I've truly enjoyed getting to know you during this call, and I know a lot of our students have as well.
Oh, thank you. I love the questions, too. You've got a great group.
We do. So when we do a live event, I'll have to coax you from your beachside villa in Mexico to attend our live event. So Julie, any other closing comments?
No, absolutely. Our utmost thanks to you, and we look forward to an ongoing relationship. We really appreciate your willingness to share and answer a lot of our students' questions. So thank you, and I can see maybe doing a follow-up interview in a few months.
That sounds great. Thank you.
I'm going to throw this out there to the audience because Diane and I just touched on this. If you guys would be interested in taking a coaching program that was taught by Diane, which was geared towards a lot of the things we talked about on this call, but also towards wealth accumulation, wealth building, things of that nature. Obviously, she's an expert on that. If you'd be interested in having Harris Real Estate University start a coaching program where Diane would coach that program, let us know. Just send me an email directly at tim@harrisrealestateuniversity.com, tim@harrisrealestateuniversity.com. Frankly, I think all of you should be interested in that, but give me some feedback. Let me know if that's something that you'd be interested in, tim@harrisrealestateuniversity.com. So, Diane, on behalf of Julie, myself, and all the faculty and staff of Harris Real Estate University, I want to sincerely thank you for your time today, and all of you have a terrific weekend. And again, thank you, Diane.
Thank you.
Bye-bye.